Good morning and welcome to our board meeting today. We're going to have three topics today. First, we're going to begin the redeliberations of our project to distinguishing liabilities from equity, including convertible debt. And then we're going to turn our attention to a staff update of the research they've been doing on segment reporting, followed by the research they've been doing on financial performance reporting. So I'll turn over to the team to begin the discussion on distinguishing liabilities from equity.
Thanks, Russ. Today's meeting on liabilities and equity will be a decision-making board meeting. On July 31st, a proposed update was issued and the comment letter period ended on October 14th. We will provide a summary of the feedback received from the comment letter respondents, as well as feedback we've received through supplemental outreach performed. Today, we will also provide some analysis of the comment letter feedback, and the board will be asked to begin its redeliberations by making decisions about the overall approach, including reaffirming some of the amendments in the proposed update. We will also share the details of our redeliberations plan and ask board members for feedback on that plan. In terms of the flow of the meeting and the topics, we've got, for the board members, Memo 30 included the comment letter feedback, and then Memo 31 included the analysis. What we've done is we've broken up the tee-ups by topic. So for each topic, we'll discuss the comment letter feedback that was in Memo 30 and is also in the handout. And then we'll discuss the staff analysis that was in Memo 31 and the questions that are in Memo 31 in the handout. So first, I'll start with a summary of the overall feedback on the proposed update before we dive into the individual topics. So we received 23 comment letters, and overall, the comment letter respondents were supportive of the board's efforts to simplify this area of GAAP. We'll discuss the feedback in more detail as we go through each area, but at a high level, most respondents agreed with the proposal to account for convertible instruments as a single unit of account, to remove certain settlement conditions, to align the diluted EPS calculation method for convertible instruments, and to remove the ability to overcome the share settlement presumption for contracts that may be settled in cash or shares in EPS. Respondents had mixed views on the addition of a remote threshold to the derivative scope exception assessment and the related changes to the reassessment timing. Additionally, subsequent to the issuance of the proposed update, the staff conducted supplemental outreach with financial statement users and with various advisory groups. Financial statement users were generally supportive of the proposed amendments, consistent with the feedback we've received throughout the project. So now I'm going to turn it over to Lucy, who's going to take us through convertible instruments.
Okay, thanks, Mary. So out of all 23 respondents, the majority of them supported the board decision to account for convertible instruments as a single unit of account, as Mary mentioned, except in circumstances in which the conversion features are required to be bifurcated under Topic 815. They agreed that the proposed simplification with sufficient disclosures would provide more decision-useful information and reduce the cost and complexities in this accounting area. Some respondents who disagreed with the proposed model commented that it would not appropriately capture the economics of the convertible instruments and would cause GAAP inconsistency. Instead, they suggested different alternatives, such as a single separation model based on the cash conversion model or the stock compensation model, or a single unit of account model with recognition of a hypothetical interest expense. Some respondents asked the board to prohibit the recognition of negative interest expense under the single unit of account model for convertible debt with substantial premium. During supplemental outreach, users' views on convertible instruments were largely consistent with the views expressed during previous user outreaches. All users in this outreach supported not separating the conversion features from the host contract because they view and analyze the convertible instrument as a whole instrument. Users also emphasize that coupon interest expense, rather than the imputed interest expense resulting from the separation models, is more relevant and critical for their analysis. Most users said that the imputed interest expense usually is backed out from their analysis and does not need to be included in the income statement. The staff's research on non-GAAP income adjustments corroborates this point. Regarding disclosures for convertible instruments, most of the respondents and all users during supplemental outreach agreed that the proposed amendments provide decision-useful information. Some respondents commented on the appropriateness and cost-effectiveness for certain proposed disclosures or requested additional guidance or clarification. A few users expressed an interest in a disclosure about an entity's current non-convertible interest rate. that is updated for each reporting period for the reference purpose or the analysis. The staff does not identify any additional new information from the comment letters and supplemental outreaches that would cause the board to reconsider its decision on the accounting for convertible instruments. Noting the broad support from the comment letter respondents and financial statement users, the staff recommends that the board affirm its decision that convertible instruments should be accounted for as a single unit of account, except in circumstances in which the conversion features are bifurcated under Topic 815. As discussed in Memo 31, the staff considered the alternatives suggested by the respondents who disagreed with the proposed amendments. However, the staff noted that those alternatives have conceptual and mechanical flaws, and there would still be various issues that need to be further addressed. The potential solutions to address those issues may result in more accounting complexities and costs for preparers and practitioners, and the staff does not think that those alternatives would be relevant and useful for users. Therefore, the staff does not think that further consideration is needed. Based on the comment letter feedback, if the board affirms its decision on the single unit of account model for convertible instruments, the staff plans to analyze the potential issue related to the negative interest expense for convertible debt instruments and other feedbacks on the disclosures. These topics will be discussed at a future board meeting. Some comment letter respondents requested the board address issues related to the share settled debt, debt with detachable warrant, and conversion features that are accounted for as derivatives. However, the staff does not plan to include those issues in the redeliberations because they had been discussed during the initial deliberations and determined to be beyond the scope of this project. Now I turn it over to the board to discuss questions 1 and 2 in the handout.
Thank you. Are there any questions before we ask the members of the board their views on question 1 or 2? Are there any questions about the comment letter summary or the additional outreach that the staff did throughout this process? Okay. Al, maybe?
No.
Might have a question? About the reader? Well, go ahead. No, go ahead, because it's kind of embedded in question 2.
Okay. I've made a couple notes on this is in Memo 31 on paragraph 12A1, little I. I couldn't tell if you were supportive of this notion of considering prohibiting recognition of interest income in certain circumstances. It was a little unclear to me whether you said, oh, the issue was raised, so we'll look into it, or you were actually supportive of that notion and thought.
We plan to look into it first to assess the pervasiveness of this issue.
Okay, and I would agree with that because I'm just not certain how pervasive it was. Is this a recognition of the fact that in certain areas of the world, if you're holding instruments from those areas, you could actually face this type of situation? It wasn't so much of a U.S. issue, but it was if you were dealing with instruments from around the world, you could be dealing with it. So I would argue the issue is pervasive, just not here in the U.S. So.
We will come back with some data analysis.
Okay.
Besides the staff research, also some public companies' data analysis to assess its pervasiveness.
Okay.
Yeah.
Jim?
So I agreed with the redeliberation plans, but I had really just 2, I guess, comments or points. One, a number of the commenters pointed out that sort of their view that we're not capturing the full economics of convertible debt. And I had somebody reach out who participated through the comment letter process as an accountant who I really respect, and he went back to the basis and the dissent in APB 14. And I think 3 members of the APB dissented to APB 14, which did not require separation. It's the model that we're going to. And they dissented because they said the end result is you could have a high credit quality company issue debt without a conversion feature and a low credit quality company that embeds a conversion feature. The net result of that is to show a cash interest expense that is the same between the 2 companies. And that is the effect in the P&L. And so I agree that that is not neutrally then reflecting the two companies because you got economically different instruments. But based on the pervasive feedback that we heard from users that said they already understand that and that the entirety of the arrangement is understood by looking at the balance sheet, the notes, the income statement, and included in that the earnings per share or the dilutive effect. I think there is a much more straightforward way to get to that end result. And I just want to be clear as clear as we can in the basis, and perhaps it already is clear, that it isn't that the board is confused by the fact that these are two different arrangements and the accounting and the income statement looks the same. The information is derived beyond further than the income statement. And the person who made that point I have tremendous respect for, and so I don't think it was coming across to them in our basis. And so I just want to make sure as I review it, we're as clear as we can be. Second point on negative interest, which I think it's impacted by rates, but really has nothing to do with whether your rate is in the environment is negative or not. I've seen convertible debt today, my recollection, be bought down effectively to the point where you were generating interest income, and it wasn't that the rate for the entity was negative. It was that the embedded conversion feature was either in the money enough or valuable enough that it drove the rates to negative. So as you look at the pervasiveness of that, I think part of that is that we're opening up the opportunity to make it much easier to buy down your rate to a negative rate. Again, it happens. I'll give you the name of the company where I think it happened offline. There may be more. I just think we're opening that up to a broader population. I don't have a view at this point whether we should prohibit it or not, but I do think research into not just how pervasive it is, but how much did we open it up for that.
Christine?
I just wanted to second Jim's first point on faithful representation. I think the situation that we have currently is one where we might be able to argue that the accounting does more faithfully represent the underlying economics of the instrument, but we end up with information that users have said is not relevant and that they undo the accounting. So we're putting cost on those users to get back to information that they perceive as more relevant. It doesn't happen really, I don't think, all that often that we end up with a conflict between faithful representation and relevance. But when we do, I think then we need to side on the side of relevance, because otherwise we're giving information that just is not decision useful, and again imposing costs on users to get to something that is decision useful. So I was sympathetic to the comment, but ended up in the same place as I was before.
I want to say something and ask you a question. Fine. Or Hal, either one. So I too was approached by a few people who I greatly respect, one of which did not write a comment letter, but asked in essence the same question. And I talked about our research, and I talked about an observation that yes, there are different economics, but investors do not want to see that different economics. And I asserted it's because this is viewed as a financing activity. The individual then appropriately asked, well, can you compare and contrast that approach to stock-based compensation? Why do investors want to see stock-based compensation and the value associated with that equity, but not the value associated with this embedded call option? I said, because I think that's more of an operating activity. And I wanted to ask you, is that similar to how you all, as former professional investors, would think about it? And that there are times when companies give equity that you do want recognized, but other times you give equity that you don't need it to be recognized. And is it because that one is likely a financing, whereas the other one is not? And that just came up yesterday.
You know, I think, both stock comp expense and convertible debt, no one knows what the ultimate number will be in the income statement, the balance sheet. So I don't think of these two as the same. I mean, stock comp expense, I pay my employees stock compensation. A lot of it today is RSUs, which is a form of deferred comp. I don't view deferred comp in the similar manner to convertible debt. I understand the argument about faithful representation, but, I participated in the outreach. We've heard consistently that investors don't care about this phantom non-cash interest income. or interest expense, they back it out. If you think about, when I'm doing the analysis of a company, what I only care about is the cash coupon interest and the ultimate dilution to the shareholder. So those are the two key pieces. I understand where accountants come from, about the faithful representation, the nuances that, people that understand all the potential implications of this, but I go back to when I've talked to a number of people on our committees who are investors, and I mentioned, did you know we have 5 convertible debt models? None of them were aware of that. And these are the people who come here who are more sophisticated than a typical investor. So the model is, people don't know about the models. Therefore, if you have something that no one's aware of, and the whole theory behind, the imputed non-cash interest expense is, I think, again, an interesting debate, but it's not relevant to investors.
I struggle with this issue a little bit because I heard all the same things that Gary did. And frankly, I didn't see this very often because this is a very expensive form of debt to be issuing. So the companies that I was following typically did not get themselves involved in this. The only thing I would take a little bit of exception with what Gary said is I think that when it's important for those companies that are using this type, investors do dig into the details and they do understand the nuances and differences. So I think when it really matters, they do. But at this point, I'm not. To me, this isn't that big of an issue, and I understand why they're not. They're in effect looking through it in this particular case. Whereas stock compensation, that is going to be generally a much more relevant type of number for any company that's issuing stock comp.
Yeah, I wasn't implying that investors look through convertible debt. We have excellent disclosures on convertible debt. You can either go to the prospectus or you can go to the footnotes. So if you have a company with significant convertible debt, every analyst is looking at the potential dilutive effects, what potential payout you have to make if it doesn't convert. So that's straightforward. I don't think that's on the question. The key is, how do you account for it?
Okay. Let me call a vote with respect to both questions 1 and 2 in the board handout. Question 1 is asking us to affirm the view that's in the exposure draft with some clarification improvements in the basis. Who agrees with that? That's 7. The staff has articulated to us in a board memo as well as today what is the redeliberation plan for some additional items that have come up related to convertible debt. Who agrees with that plan? 7. Okay. Recognizing we can always improve the plan as we learn more, so we're not locked in on that. Okay. So now we'll turn our attention to earnings per share. Rachel?
Next, we will be discussing earnings per share. The proposed amendments to EPS were limited to areas within the overall scope of the project and were intended to improve consistency within the EPS calculation. Generally, both comment letter respondents and users that participated in supplemental outreach were supportive of the EPS amendments. Most expressed a preference for changes that resulted in the maximum dilutive impact for diluted EPS and provided increased consistency in the calculation. The amendments related to 2 key areas: the if converted method and the rebuttable presumption about share settlement. First, the proposed update would require all convertible instruments to be calculated using the if converted method for diluted EPS. The majority of respondents were supportive of the changes and said that the amendments both simplify and increase consistency for the diluted EPS calculation. A minority of respondents disagreed with the proposed amendments because, in their views, the proposed amendments would not create a single aligned diluted EPS calculation because of how the if converted method would apply to convertible instruments where the principal is required to be settled in cash. Additionally, some respondents asserted that the amendments would create volatility in the EPS calculation. The staff plans to further analyze this feedback on the if converted method for discussion at a future board meeting. Second, for instruments that can be settled in either cash or shares, an entity must presume share settlement when calculating diluted EPS. However, current GAAP allows entities to overcome this presumption in certain cases. The proposed update removes an entity's ability to overcome that presumption. In other words, under the proposal, an entity must include shares and diluted EPS in the diluted EPS calculation if there is a possibility that the instrument may be settled in shares. A majority of respondents and all the users the staff spoke with during the comment letter period agreed that the proposed changes would simplify the calculation, improve the consistency in the calculation, and better align diluted EPS with the objective of diluted EPS. The minority of respondents that disagreed cited the ability to rebut the presumption of share settlement presents a more accurate measure of diluted EPS, which better reflects the economics of the instrument and results in a less volatile diluted EPS. These respondents asserted that management intent should be factored into the diluted EPS calculation. For question 3, the staff recommends that the board affirm for a contract that may be settled in cash or shares, an entity should presume share settlement for calculating diluted EPS, and that the presumption cannot be overcome. While a minority of comment letters disagreed with the proposed amendments, they did not raise any new information. If the board decides to affirm this decision, the staff plans to analyze clarifications requested by comment letter respondents for discussion at a future board meeting. For example, the interaction of this decision with contingently convertible shares. Additionally, at a future board meeting, the staff plans to discuss the other EPS-related amendments in the proposal, such as the use of an average share price when there is variability. I will now turn it over to the board to discuss questions 3 and 4.
Thanks, Rachel. Christine?
So I found the arguments put forth by the minority that taking management intent into account in the EPS calculation better reflects the economics, and that we should therefore continue to do so. A little curious, because it would just seem that if you're going to make that argument, then it's not about EPS, it's about classification of the obligation in the first place. So it would seem that if you're making the argument that management intent is to pay this thing off in cash, and therefore it's not really an equity, then it would seem you should take that into consideration in classification and classify it as a liability in the first place, and then you wouldn't have this EPS issue. I'm pretty sure that's not what the argument was. And so I just found that disconnect in the argument to be somewhat unsettling. So as a result, I'm quite comfortable with the decision that we made. I think it's the appropriate decision. I think it's appropriate that intent should not be taken into consideration in the classification, and similarly should not be taken into consideration in the EPS calculation.
Jim?
I agree with Christine. I always viewed that as just effectively a loophole. We're getting rid of the loophole. I think your redeliberation plan has you coming back with the application then to instruments, what is it, C, X, and maybe comparing that to a plain vanilla. So I look forward to that. I think there was some tension about the application of the if converted when you're partially settling cash or not. I think that all works, but I think illustrating the practice of those three, or how in practice those three instruments will look either similarly or differently will be helpful in the redeliberations.
Gary?
Yeah, I'm not going to repeat what Christine said because I thought it was perfect, exactly my sentiments. I think the more important part is that it makes the presentation of the information more comparable. When you have A and B choice, and B, I question the validity of it. So you have one choice, A, which I think is more faithful representation of what's going on, and B is kind of a, whatever you want to call it, a second choice that really doesn't reflect what's happening. So I think this is a good solution.
Sue?
For me, removing the intent-based notion of it actually provides consistency with the objective, and so that's why I'd support the staff's recommendation.
Hal?
Have we ever considered requiring both the intent and then the approach that you're suggesting? Because as I read and listened to the users come back and said they want the, quote, conservative number, but I also am inclined to accept the argument that it's not necessarily faithfully representative of what's going to happen. So, and I know Russ and you and I in our small group meeting, you really emphasize, it sets a boundary, an outer boundary. And I think that's a good piece of information to have, but I also liked having and here's what management actually thinks is going to play out. So would we ever consider an approach that had provided or required both pieces of information?
So I think what we were concerned about is that this, when you look at where this is allowable, where you can overcome this presumption and look at intent is just one aspect of EPS. And when you look at the rest of EPS, it doesn't allow for that. So, I think if we were going to do something like that, you'd have to look at, for example, the if converted method. Do you estimate whether you think it's going to convert or not? And you'd have to be consistent across the board. And we thought that was just more of a wholesale change to EPS beyond the scope of what we were trying to do here.
Hal, I think we do, though, sort of do what you want by having basic EPS, which is this is before the dilutive effect, and then diluted EPS, and then if that's different by more than X percent, I think you have to show the my recollection is you have to show the reconciliation, and so you would then see by instrument the input, but it has to be different by more than, I think it was 3%, which I guess was, look, if they're not that different, you don't need to know the guts.
Okay. My comment was different. I didn't want to jump in on that conversation. I just wanted to say I'm comfortable with our position on EPS and thinking about the conversation we had when we were talking about question 1 and some of the alternative models that were presented and the scenario where you could have a high quality straight out debt instrument, a convertible feature, and interest expense looks the same, but yet to me, this treatment in EPS is what is the trade-off and what distinguishes the difference between the company that issued a convertible versus the one that did not. So when you look at the EPS numbers of those two scenarios, you see a difference, and that's another reason why I'm very comfortable with our conclusion that this is a fair presentation.
So I have nothing to add from a technical standpoint on the basis for the conclusion. I support the staff's recommendation. I understand in the small group meetings that if we affirm your recommendation, we're not going to word it the way that's in paragraph 3. A plain English way of saying you can do the presumption, but you can't, I think confuses people. So we're just going to say if you have the choice of cash or share settlement is what's included in EPS, just so that people who are reading the handout recognize we're not going to say it's a presumption, but it's not.
Yeah, and I think just that the way it's worded in the proposed ASU is more in line
with that.
The question just a little.
This was just a way to help the board understand the two alternative views is all. Yeah, Hal?
And I wanted to give a little bit more thought to Jim, so I thank Marcia for giving me a little time to think about it. If you all...
weren't listening?
What? No. I listened to every word, Marcia. If you maybe on the side can walk me through the reconciliation, when does it kick in, when does it not? I'm still a little bit troubled by what I'm going to call the boundaries approach, where you've got basic and fully diluted, and so the true expected numbers lie somewhere in between. And while I appreciate 3% may not sound like a lot, when you miss by a penny, that seems to drive a lot of action. So I'd like to be a little bit more educated and possibly encourage you to do a little bit more outreach on that issue, because I don't think that's really fully well understood in the investor community. Okay.
Okay, let me call a vote with respect to questions 3 and 4. Question 3 is, in essence, affirming what we have put in the proposed ASU related to cash or share settled EPS. Who agrees with the staff's recommendation? Okay. And question 4, we've got the staff's redeliberation plans, which have articulated, has been asked for additional research on the matter Hal talked about. Who agrees with that plan? Okay, that's 7. Okay, so we'll move on now to derivative scope exception. All right.
All right, so the proposed update would amend the derivative scope exception for contracts in an entity's own equity by removing 3 of the additional equity classification conditions found in paragraph 815-40-25-10 related to unregistered shares, collateral, and shareholder rights. Most comment letter respondents agreed with the board's tentative decision to remove these conditions for the reasons expressed in the basis for conclusions. Respondents agreed that the unregistered shares condition is a source of complexity and frequent disagreement between lawyers and accountants. Moreover, almost all respondents agreed that the collateral and shareholder rights conditions are unrelated to the concept of settlement. The minority of respondents that did not support removing the collateral and shareholder rights conditions think that these conditions are more indicative of creditor rights and therefore inconsistent with equity classification. Because comment letter respondents broadly agreed that the proposed amendments would reduce the cost and complexity of applying the derivative scope exception, and no new information was provided by those that disagreed with the removals, the staff recommends that the board affirm its decision to remove these 3 conditions. And with that, I'll turn it over to the board to discuss question 5.
Thanks, Nick. Any, Christine?
So when we took the vote on this prior to the exposure draft, I was fine with the unregistered shares condition. I continue to be fine with that. But for the same reasons that a minority expressed concern about removing the collateral condition and the shareholder rights condition specifically, I view giving of collateral much more consistent with a liability claim than a equity claim. And I also view what the shareholder rights condition is trying to get at is getting, again, more towards creditor rights as opposed to equity claimant rights. I would have preferred that we looked for a place to move these 2 as opposed to eliminating them. So I continue to, that would have been my preferred approach.
I will call the vote 5A, 5B, and 5C so you can distinguish between, so it's not all bundled. That could be awkward for you. Any other, Jim?
So, I agree with where we're at. I struggle on that, the issue of particularly the collateral and the other creditor rights issue. We don't use necessarily the legal framework in distinguishing liabilities and equity. We certainly don't. I mean, most freestanding options, irrespective of whether or not they have some contingent feature that fails 075 are legally equity. They don't have any creditor rights, but we take that and say we're going to disregard the legal status of this thing and call it a liability. To me, that's sort of, we have concepts in accounting that are separate from legal for distinguishing liability and equity, and then we introduced some but not others, and I think it creates confusion. And so we're not in the spectrum that just says follow legally what this is. And so it didn't trouble me to say these things that aren't otherwise in our notion of liabilities and equity distinguishing characteristics don't become distinguishing characteristics for purposes of the accounting.
Okay, I'll call a vote. Like I said, I'll distinguish what is written in question 5 in the board handout. I'll do 5A, which will be unregistered shares, 5B will be collateral, and 5C will be shareholder rights. With respect to 5A, who would like to affirm the removal of the conditions regarding unregistered shares? That's 7. 5B, remove the conditions regarding collateral. That's 6. And 5C, remove the conditions regarding shareholder rights. That's 5. Where were you? Did I miscalculate on collateral? Were you for or against it? 4, okay. All right. 7, 6, 5. Good thing we're not keep going. We'll get in trouble. All right. Okay. Nick, are you back up? No. Okay. Erica?
Let's keep it interesting. Okay. The proposed update would add a remote likelihood threshold to the existing indexation guidance and certain aspects of the settlement guidance. As a practical result of adding the remote threshold, the proposed update would also reduce the frequency of reassessments from every balance sheet date to upon the occurrence of 1 or more reassessment events, as well as improve the related disclosure requirements. While almost all respondents supported reducing form over substance accounting conclusions and agreed that remote features should generally be disregarded for this evaluation, respondents were mixed on whether a remote threshold would be operable and or if it effective in improving the guidance. They were also mixed on the reassessment frequency, and respondents were generally supportive of the proposed disclosure changes. Respondents that supported the proposal said that remote would be operational because it's utilized in other areas of GAAP, and that a lower threshold would be more subjective than remote. Additionally, users that the staff spoke with during the comment letter period were supportive of the board's decisions and were not concerned that it would result in loss of useful information. Respondents that did not support the proposal on remote said that it would add subjectivity and audit risk to the model, and or it would not make enough of an impact in improving the guidance because only contracts that with truly remote settlement features could be equity classified. These respondents would prefer the board take a different approach, such as a more holistic review of the scope exception guidance overall, or select a lower threshold, such as more likely than not. For question 6, the staff recommends that the board continue with developing the remote likelihood threshold because the staff thinks that no new information was provided by those that disagreed with the proposals to make the board reconsider this. Although the feedback was mixed, the staff observes that most respondents that disagreed would prefer that the board explore alternatives that would allow additional contracts to be equity classified, which the staff notes was not the objective of the project. If the board decides to continue with pursuing a likelihood threshold, the staff plans to analyze suggestions from the comment letter respondents to identify if there would be a way to improve the remote threshold, improve the operability of it at a future board meeting, as well as perform outreach with auditor regulators to understand how they might enforce the guidance. The staff also plans to analyze the feedback on the frequency of reassessments, the list of reassessment events, related disclosure requirements, as well as any additional technical corrections or improvements that were in the scope of the proposal. The staff does not plan to research areas suggested by comment letters that were out of the scope of the project, which includes amendments to Topic 480, SEC temporary equity guidance, and Step 1 of the indexation guidance. With that, I'll turn it over to the board to discuss questions 6 and 7 and associated feedback.
Christine?
So I was not supportive of the approach that we were taking before. So in thinking through the decision as to whether or not to continue the project, I tried to think, well, what changes could we make that would make me more comfortable? I already know, everybody else is probably okay, except maybe for Al. So it comes down to not just the remote assessment, but the remote assessment combined with the frequency of reassessment, and that it's those two things working together that cause my discomfort. My concern being that under the proposal, since there is not a reassessment of that original remote decision until some triggering event actually happens, that it's going to put a lot of stress on that initial evaluation as to whether or not this thing that they're worried about is going to happen or not. And I think that's going to put a lot more pressure on the auditor to judge whether or not that assessment that's been made by management is appropriate or not, because managers are going to want equity classification much more than they are going to want liability classification. So there's going to be a natural desire to conclude that something is remote. So now the auditor, is going to have to provide a much stronger monitoring role, and similarly the regulator is going to have to kind of be the bulwark between the two classifications. So I think that I worry that there's going to be all this pressure, and it's actually going to result in an increased likelihood of restatements when the thing happens, and then the second guessing happens about, well, was it really remote? It happened, and it was in the contract. So I'm worried about that, and I'm worried about that we're not curing form over substance. We're just moving form over substance. We're moving it from the liability section to the equity section, because there will be items that are going to be in equity where we know this thing is going to happen, and we know that it's going to end up being settled in a fashion that would be more consistent with liability classification, and yet it's going to sit there in equity until that thing happens. So we're going to end up with form over substance, but now we're going to end up with it in equity where the disclosures are less robust for users of financial statements. So then the question became, okay, well, some of that could be addressed by requiring the reassessment to be done more frequently. But if we do that, then where's the cost savings? So after giving this a lot of thought, I really end up in a place where I just don't see a conclusion where I'm going to ultimately say that there was a substantial reduction in cost without harming the quality of the information, the relevance of the information for users. And so I would prefer that we move forward with the components related to convertible debt, and that we not keep working on the remote assessment.
Hal?
I share all of Christine's concerns. The only difference is I have no trouble continuing this effort if we can come up with some reasonable, rational approach that works for us. But I'm skeptical that we'll get there. But I'm not opposed to the staff continuing to work in this area.
Jim?
And that really is what the vote is about, right? It's not.
Yeah, I mean, there's, it's in paragraph 42 of the board memo. I don't know about the handout, but there's actually 4 views. Either proceed with the remote threshold, proceed with the remote threshold just for private companies, reverse the decision to add a threshold, and then D is just say, look, we're going to have 2 different projects. I guess A and B are a likelihood threshold, but not necessarily remote.
Yeah, and we were just, those were just if we move things we might be able to do, so we weren't necessarily thinking of those as alternatives to vote on. I think just given the mixed feedback, before we go do more work on this, we just wanted to touch in and say, do you want us to keep going, or do you want to kind of go a different direction?
Your point is, even if we proceed on remote, there's a likelihood threshold, there's more work to do.
Yeah,
Yeah,
that
so
was
I
it.
guess A and B are not really remote.
And I'm
we're
just
gonna have a
the
threshold.
way the wording, the way the question is worded in the board handout, it's really, do you want to just continue proceeding? I'm not ready to kill this.
Yeah. So question 6 does say remote. That's why I thought A and B were remote.
Well, it
but
says
we could
continuing to develop
a remote likelihood.
Right.
Yeah, I think it was just if there was.
Fine.
It's like a
if there was
directional
preference
leaning of-
not-
Yeah.
If there was a preference not to keep going, we didn't want to do the
I'm
following.
directionally leaning against
Leaning against a threshold.
a threshold,
Yeah.
but the question is, continue to develop it? I don't like to kill off options and approaches too early. If we can learn more,
Like the slow.
I like the slow bleed, yes.
Go ahead, Jim.
So my first choice with this project, my vision long term is more of one that is a predominance consistent with, I'll get the COD section wrong, but 150, which is we already have a test that says if something's payoff profile is predominantly indexed to something other than your shares, then it's not equity. I think we could do the exact same thing for freestanding instruments in this form in the literature would hold together more clearly, and frankly, I think would result in more things that have equity payoff profile being classified as equity if they're paid off through equity, and things that pay off like derivatives or financial instruments being classified as liabilities. That seems to me to work. I will ultimately, I support going this way. This deals with one aspect of that, which is if it's remote that the payoff profile would deviate, then it doesn't cause you to be a liability. What it doesn't deal with is magnitude. So I could have, and I think most of these features, even when they become probable, I shouldn't say most, many of these features, the adjustment is minor in terms of the payoff differential to you to other equity claimants. And so it doesn't deal with magnitude. That is, if a business combination occurs, I get a slight adjustment to my number of shares. It's not that I suddenly get a fundamentally different payout. It's a slight adjustment, but it doesn't matter under 075, any adjustment. So this deals with likelihood, but not magnitude. The reason I support going there is I view this as an evolutionary process. Perhaps this deals with many of the practice issues and we don't even need to go further in the future. But if it doesn't, we'll find that, hey, this dealt with one side of the issue, it didn't deal with the other. That leaves open a longer-term path. I do support all of the things you say we ought to follow up on, including, the auditability questions. Christine's question about does it put more pressure at the assessment date? I think theoretically the answer to that is no. The auditor will say, if I have to audit remoteness, I have to do the same audit procedures, whether or not I have to redo those next year or not. In theory, the amount of work is identical. Then the question is, in practice, would I do less work if I have to reassess later? I think getting a true answer to that might be difficult, because I think it'll be hard for people to say, no, I'll do less work. But I think finding ways we could probe that. I also think the questions that got raised about, is it an individual feature by feature assessment, which I think is on your list. Does each one have to be remote? So one's got a 5% chance and the other has 6. Do I add them? I think all of that is great in redeliberation.
The approach that you talk about on considering this as a private company alternative, I agree that the decision-making framework doesn't seem to support it, but why? Was there something in the outreach or the common letter process that led you to believe that there is more acceptance in the private company community or more ability to audit in the private company community? I mean, I read some of the larger accounting firms' conclusions that seem to have more concern about auditing remote than some of the smaller firms, but I didn't know if that was a consistent theme or follow-up in your question.
I think kind of earlier on in the project, it seemed like there was a split between kind of private companies versus public companies. But based on the comment letter feedback, it doesn't appear to be that. It seems that it was a little bit mixed. So we can look more into that, but I think it didn't really appear that there was a obvious glaring split.
Okay. All right. Anything else? So the staff, in essence, is asking for direction, really, on how to focus their attention. And I think it's really between 4 paths. The first path would be to continue to develop a threshold focusing on remote. The second would be to do that, but only do it for private companies. The third would be to, in essence, I guess, to not have a threshold and make no changes in index and settlement guidance. And then the fourth one is to spin it off and look at it holistically. That's kind of those are kind of our various ideas right now, anyway? Okay. So who would support proceeding down an approach with a threshold focusing on remote at this time? So that's 5. And you all would prefer a spin-off approach or not discuss approach? Holistic approach.
I'd just drop it. C.
Okay, all right. Okay. All right. Staff's talked about their plan. Any additional feedback? So we have broad agreement on the plan for those that want to proceed.
Yeah, I would like to also, I think you touched on it in the memorandum, but, there's other areas in GAP where we have remote thresholds to compare and contrast. Just operability, I think, would be helpful.
So the proposed update included 2 questions that were meant to solicit feedback on areas that are currently outside of the project scope. First, the proposed update asked respondents whether new fair value disclosures should be considered for public business entities for all equity classified instruments. All comment letter respondents that answered this question, except for one respondent, did not support such disclosures because they would be too burdensome and they would not provide any additional useful information beyond what is already disclosed. Accordingly, the staff does not recommend that new fair value disclosures for all equity classified instruments be further considered. Second, the proposed update asks respondents whether the board should consider a project about the effect of anti-dilutive instruments on the diluted earnings per share calculation. Comment letter respondents who answered this question had mixed views on such a project and also suggested other targeted or holistic changes to the earnings per share guidance. Noting the lack of feedback about pervasive needs for a project, the staff does not recommend the board further consider any additional research on these EPS topics at this time. I will now turn it over to the board to discuss question 8.
Okay. You want in on question 9? I'm thinking you might.
I just wanted to provide some support for my academic colleagues that wrote in and said we should be doing a holistic project. If we were going to go down this path of looking at it, I would want to look at it more holistically. So I don't think we should do anything in this area because I think targeted is just going to open up a can of worms.
Yeah, as it relates to the anti-dilutive, I think it's effectively opening up EPS a lot more broadly than just that question, and I wouldn't do that. I think my understanding is for most companies that have those types of instruments, they're already providing supplemental communications to help management investors understand the impact, which I guess makes sense because when it's good news, it's a lot more compelling to want to tell people perhaps than if it's bad news. And I'm not saying people are hiding anything. It's just, it happens to, put things in my favor, and I want to call that out, and companies already do that.
Gary?
What I've seen in footnote disclosures, companies who spend the money to these anti-dilutive instruments, options, whatever it might be, it's in the footnote. You're spending that money, you want to highlight it to investors. So I don't see the need here for accounting to solve the problem when disclosure works fine.
Okay, so the staff has given us a question 8, which talks about, and the recommendation is that we not change the scope of the project to include fair value disclosure for equity instruments or additional information about anti-dilutive instruments in potential EPS project.
Could we vote on those separately?
We will. Yeah, okay, that's good. So that's in essence your recommendation. Right, okay. So with respect to 8A, which will be to not include within the scope fair value disclosures for equity instrument, who agrees with the staff's recommendation? So that's 6. With respect to question 12, who agrees with staff's recommendation not to include additional work on anti-dilutive instruments? Yeah, that's 7. Okay. All right. So now we'll proceed.
Yep, so the last topic we have is just transition, redeliberations plan, and next steps. So regarding transition, the comment letter feedback about transition was included in Board Memo 30 in the handout. We're not going to discuss that in detail today. After the board makes decisions about all the technical aspects of the project, we'll discuss that at a later date. In terms of the redeliberations plan, we've talked about key redeliberations areas today. In addition to those areas, we'll also look at other areas we haven't touched on, such as comment letter responses about private company considerations, responses about potential unintended consequences, the various technical corrections that were included in the proposed update, and then we'll bring back effective date and cost-benefit analysis. And in terms of timing, we plan to come back in the first quarter to continue redeliberations.
Any questions about the staff's plan? Okay. Great. Well, thank you today. Before we dismiss this team, I just would like to congratulate Rachel Cole. Rachel's been with us for a year as a postgraduate technical assistant. She's worked on this project and other projects and has been a crucial part of the team. Rachel is off to New York, where she's going to go join Blackstone. So congratulations, Rachel. Hal, I need a cup of coffee, so what do you say we take a break? Okay, welcome back. I guess I got my coffee, so we can go.
You're good to go now.
It's for those of you listening, it's an inside joke. Hal thinks I drink too much coffee. Anyway, we're now going to turn our attention to segment reporting, but before we do, I'd like to introduce Chris Bodan, who's a new member of the FASB staff. So this is your first and what I hope is many meetings in front of the board. And so with that, we'll turn it over to Lauren to begin the segment discussion. Thank you.
Thanks, Russ. Good morning, everyone. The purpose of this session today is to report back to the board on the feedback that we received to the 2019 disclosure study. For the benefit of those who are following along remotely, much of the materials that we're going to discuss today is included in the board handout, which is available on the FASB website. In terms of running order, we have 3 technical memos to be discussed. The first paper is Memo 9A, and it discusses the research that we did in terms of segment reconciliation requirements. Sophie is going to introduce that memo. But just briefly, much of the research that we did in paper 9A required the assistance of Melissa Nicholson from the XBRL team, who is here. It involved a lot of hand collection of financial statement data, so I wanted to publicly thank Melissa for her help with that. The second technical paper is Memo 9B, and it discusses the staff's analysis on how the issues that we included in the study align with the conceptual framework. I will tee up that paper. And finally, the third paper is 9C, which is actually the feedback summary from the messages that we received to the 2019 disclosure study, and Danielle's going to introduce that paper. While the study actually focused on 8 issues, several participants, external reviewers, and others raised issues beyond the original 8 that we included in the materials. The table in both the memos for the board members and in the handout for today refer to all of these matters. With that, I'll turn it over to Sophia to introduce 9A.
Thanks, Lauren. The first technical paper for today's discussion is Memo 9A. It is a summary of the staff's research regarding the current practices of U.S. public companies in reporting segment reconciliations from the total reportable segments amount to a total consolidated amount. Using XBRL data, the staff collected information about the number of reconciling items per reconciliation, as well as the most commonly used captions of reconciling items for a sample of 30 small, 30 medium, and 30 large public companies. This memo also explains how the staff incorporated the findings of this research into the 2019 disclosure study. And with that, I will turn it over to the board for any comments on the staff's research.
Thanks. I know we all had an opportunity to participate in some, each of us had an opportunity to participate in some of the calls, where the staff participated in all the calls. Any additional observations or emphasis? I thought what you did was excellent. I thought the calls were great, very, very informative, enjoyed them. Okay.
The next technical paper is 9B, and it documents the staff's analysis on how the 8 potential improvements that we explored in the study align against the conceptual framework. We understand that the board typically likes to have this type of analysis undertaken at the beginnings of a technical project. In general, most of the ideas align with one or more aspects of the concept statements, and as a result of the study, we did, as I mentioned, we did identify some additional standard setting opportunities. Due to their infancy, we did not evaluate how those additional items would align against the framework. With that, I wanted to see if the board have any comments on Memo 9B, and I'll open it up.
Thanks. Christine? I thought you might have a comment.
Yeah, so now is the time for my normal off-the-wall academic comment that doesn't align necessarily with the way we have things structured in the concepts. It just struck me when I think about the presentation concepts and our disclosure concepts. By the way, before I start, I thought the staff did a really nice job of applying the disclosure concepts. So. But I just found it interesting because here we're talking about disaggregation of information in a note. And obviously the note disclosure concepts apply. But when we think about the presentation concepts, they're also about when to disaggregate versus when to put things together. And I know that we call that the presentation chapter, but it just struck me that there was some items in there for just thinking through when should things be disaggregated, really seem to apply beyond just the financial statement presentation, but also within the note disclosures. That's more of a comment maybe for the concepts team, but I don't know, it might be worthwhile for the staff to just take a look at those concepts and just keep them in mind as we think through the level of disaggregation that may or may not be relevant.
I think that's a good point. That seems that may be isolated just to this project, though.
Yeah.
Yeah.
Yeah, I think this special project, in that sense, I agree.
Okay. Any other observations on the? I thought the memo. I agree with Christine. I thought the memo was very helpful. And appreciate you doing it. Okay. Danielle.
All right. The 2019 disclosure study sought feedback on 8 specific issues. 32 preparers participated in the study, and a number of additional issues were identified along the way. A full list of the disclosure study issues and the additional standard setting opportunities can be found in the handout at paragraph 6. I won't go through the details of the feedback for each issue, but I'll provide a very brief overview of the main themes from the issues included in the study. Issue A, although there were no operational challenges identified, many participants questioned the usefulness of a disclose or explain requirement because they felt that users could properly infer the reasons why items are not disclosed. They also expressed concern that the resulting disclosure would be boilerplate. Issues C and D. The study explored different ways to require additional disclosures by reportable segment. One option was to add specific items to the list of currently required disclosures, and the other was a principles-based approach. Overall, participants preferred the principles-based approach because of the flexibility it provided to communicate information using the management approach. That said, there were some operational considerations related to the effective allocations and identifying an appropriate level of significant expenses. Issue E. Many participants expressed concern about the proposed clarification of the term regularly provided as it relates to reporting frequency, because it could include annual intervals. Those participants noted that it would be odd to characterize information in GAAP as being regularly provided to the CODM at intervals that are less frequent than the SEC's periodic reporting requirements. Issue F. Several participants identified operational challenges related to separating corporate and unallocated amounts and questioned the distinction because, intuitively, if something is included in corporate, it is also not allocated to the segments. Issue I. For the vast majority of participants, the consolidated amounts in their segment notes tied directly to a single line item on the face of the income statement or balance sheet. Many participants noted that an explanation is unnecessary because the mapping is usually evident. And lastly, issues J and K. Most participants stated that there were no significant operational costs or challenges to disclosing how their operating segments roll up into reportable segments or the economic indicators assessed in applying the aggregation criteria. But some questioned the usefulness of the economic indicators disclosure and cautioned that it could become boilerplate. Based on participant feedback, the staff observes that the following issues likely would not yield substantive improvements to the current segment disclosure requirements, and the board may want to consider removing these issues from further consideration. Issue C, adding a cash flow measure to the list of required disclosures by segment. Feedback showed that the majority of participants do not prepare or provide a measure of segment cash flow to the CODM, and to do so would be operationally challenging. And issue E, clarifying the meaning of regularly provided. Many participants indicated that the proposed clarification aligns with the way in which the term regularly provided already is interpreted and applied in practice, and therefore no additional disclosures would be identified. From a big picture perspective, the staff believes that issue D, principles-based disclosure of significant expense categories, is the core issue that should be pursued in this project. The other issues can be added in tandem or as standalone issues to complement and enhance the usefulness of segment disclosures. Our immediate next step is to conduct outreach with investors to understand the decision usefulness of certain ideas explored in the disclosure study, and we plan to do so using illustrations. To be clear, we are not planning to get investor feedback on all of the issues that are included in the summary table in the handout. We want to focus our efforts with investors, and we have enough information to draw some educated conclusions about many of the issues. That said, we would like board member input on any specific issues you would like us to investigate as part of the outreach. And I'll turn it over to the board to discuss questions 3 through 6.
Okay. Hal, you look like you're ready. Or you're... Okay.
I know you spent some time with myself and other board members talking about these issues. I thought there was another memo 7, that did an excellent job talking about all the operational issues that companies have in terms of getting from the local ledgers to the general ledger all the way to financial reporting. And I just encourage the staff, as you're talking about this list of issues, and I appreciate why you want to focus on item D as a core, I think there's some level setting for investors to understand what it takes to get to these financial, the information that's reported. And I would encourage you all to take that memo 7 and boil it down into a flow chart or something that gives them a better sense of what the practical realities are today, not what it could be in the future, but what they are today. And I think that would help temper some of their "I want everything" types of. And look, I found the same thing. Sure, I want that. Why can't you give that to me? And I want to see if we can get beyond that type of response and have a little bit more balanced discussion with them. And I know we talked about that in private, but I just want to make that comment here for all the other board members to hear, because I think that there is just a lack of understanding of the operational aspects of it. People like Marcia understand all these issues. She's done a really good job of explaining them to me, and it's helped temper some of my, gosh, I would like this, this, and this. Why can't you get that to me? Now I far better understand, and I think we would do ourselves provide a lot of benefit here by educating investors as part of that outreach.
Yes, just to be clear, so Memo 7 was something that was issued as part of the financial performance reporting project and explaining some of the learnings we had there, but certainly the process, things that we learned and it's shared in Memo 7 apply to the same systems and concerns that might exist in certain ways within segment reporting as well.
Yeah, and if I can just add to Hal's comments, some of the things that I think, Hal, when we've been in meetings together that we've talked about, that I've tried to point out. I know we're talking now about the segment disclosure, but sometimes there's not a clear understanding that the segment information can be pulled together through a reporting tool that is not necessarily the same thing as the general ledger. And I think that's part of what Hal's trying to emphasize. And I think that is relevant when it comes into this discussion, because when we tend to use primary statement captions in our thinking, it tends to lead to a mental visual that all of that exists on a segment basis, when in reality, information or transactional detail that's been in a database can often be dumped into different systems that are used and coded for different segments, because these are not complete financial information, and because a segment measure is not the same thing as net income, not all the information of the company is included in that system. And I think that may be some of what you were trying to indicate that you've learned, because you've had the opportunity to get into this detail. So that's relevant when we're talking about the segment portion.
Christine?
So one of the things that I heard when I was sitting in on some of these conversations with companies was a concern that they were already providing a lot of information, and that they didn't have a sense that there was a need for a change in the requirements because they were already providing a lot of information. And I thought the staff did a really nice job of just recognizing up front that the sorts of companies that we engage with, that volunteer to sort of get engaged in this sort of outreach activity, are not necessarily representative of the norm. Frankly, are not necessarily representative of the ones that we need to set standards for, to ensure that adequate information is being provided to the users of financial statements. One of the statistics that the staff quoted regarding the number of segments reported by entities in the study was that on average it was 3.8 and the median was 4. But if we look at the population of companies, 80% of companies provide fewer than 4 segments. So this is a sample of good disclosures, and we're very, very appreciative of their input in the process. I don't want that to be misconstrued. But I just want to say we do need to take the feedback that we get in context of this is a sample of companies that are providing very good disclosures, but 80% of companies provide less than what these sorts of companies provide. And so we just always have to kind of keep that in the back of our mind as we draw inferences.
That, depending on where we head, could create other pressures, like what is the actual line? And so I think your approach acknowledges that if the real desire is just to get greater granularity in what is unallocated, maybe corporate and otherwise unallocated is the way to go, or maybe it's some other way to disaggregate a bigger number. So I'm interested in both of those approaches. Quite frankly, a little bit skeptical that we'll be able to draw a dividing line between corporate and otherwise unallocated, but there might be better ways to split that up. And I thought you did a good job of sort of acknowledging those, and other areas probably not dissimilar method for allocation. If we start pressing on that, we're going to then perhaps open up the question of what is the difference between a direct expense and an allocated expense. If I have one legal entity that has 2 segments and all of the obligations are incurred by the legal entity, at one hand, someone could argue that everything is just in essence an allocation of the legal entity's costs to segments. So I don't think that's what we mean by unallocated, but if we say, well, you have to define between unallocated and allocated, we may have to come up with a definition of what we think we mean by unallocated, and that could be challenging, so that might cause us to go down other paths. I think you've acknowledged that and haven't limited sort of any of that. So I thought we had a good plan going forward.
Gary?
Yeah, I think, you have a tough task assigned to you, and I think you have a good game plan here in terms of the various areas to look at. When I first joined here, when you go back to my days at Lazard, companies would come in, they would talk about by segment, great revenues, good margins, good return on assets, excellent cash flow. And then when we come here and we talk to companies, they say we can't. So the CEO and CFO go out to investors, and companies put together financial data. So the financial data from the chief accounting officer perspective is audited, internal controls, and you probably figured out the CEO is essentially talking about data that's probably financial planning and analysis data. So some group has come in and taken the firm's general ledger, operating segment data, and they've recast it to provide information for the CFO, the CEO, to make judgments about segments. So I think when we talk to investors, we've got to kind of level set that, because it's confusing to an investor to hear company one after the other talk about we have all this information, and then companies say we can't provide it. And I think that's the divide, is that one is a financial planning and analysis report, and one is a chief accounting officer report. And in particular, cash flow, every investor wants cash flow by segment. Who wouldn't? But the current CFO is not applicable to operating segments. So, is there a solution to that problem? Just in terms of the operating segments, a few of the companies that we had on the calls, one large consumer products company has 5 operating segments, 5 pieces of info per segment: revenue, margin, capital spending, D&A, and assets. That's great disclosure. They then break out the segments by business units. That's great disclosure. In my world, probably maybe a quarter of companies do something similar to that, maybe. And then maybe another 50% doing a K job, and then 25% doing a very poor job, or lack of disclosure that analysts would think is useful in making decisions. So I think what you've done here is a good start. I think this is an excellent way to go forward with investors, just to kind of run through all these different ideas and see where they come back on this information. Would it be useful? So I think it's the right direction.
Did you want to get on something he said? Okay.
It was primarily related to some of your comments about the cash flow, and I haven't been in a meeting with you in that scenario, so I can't speak from a direct, this is the intent. But when I think about someone trying to describe their business at the high level, and they may be a business that I get cash up front because I have long-term contracts and I take big deposits, that could translate into plain English speak of, I've got my cash before I make my investment. I think that's a positive business model as it relates to cash flow. I think that's very different than someone trying to say, I have a number that is tied to or even derived from the financial statements. And while we're talking about cash flow, another point I guess I would make is in my experience, and I think on some of the calls that I attended, and I would just like to thank those people that took the time to go through the study, because I think it did take a lot of time, and the ones that I attended, the companies were very prepared and very thoughtful. But when we had a conversation asking about their discussion of cash flow, indications or what they share, sometimes I got the sense that the cash flows they're talking about internally were based upon some internal management targets, again, not necessarily a term that would be measured as we would talk about it in GAAP terms. For example, you could have segments that sell to each other, so you could have intercompany activity that affects some of those by segment cash flow measures. You could also have a lot of corporate activity that's not reflected in the internal definition of the cash flow. So I found the study very helpful to try and tell us that the language that's plain English and some of the other conversations, I can understand why you would hear a plain English conversation or someone would talk about their business in a plain English way. And then when we dive into it, we start realizing when we're trying to link back to the GAAP financial statements, it's a different exercise.
Sue?
So I agree with the staff in terms of what you thought we should take off the table as it relates to cash flows and regularly provided to the CODM. From a cash flow perspective, I think not just in this project, but certainly over the years, we've heard in multiple projects the difficulty in getting information on cash flow by segment. On some of the other areas, particularly I think it's issue 3 or item D, I think is what you're calling it in the back. I am absolutely interested in continuing to pursue it. The one thing that I always, in my mind, I struggle with a little bit is that there's a fine line on the management approach and what our objective is with segment reporting, the idea being that the CODM is using this information to make decisions about the organization. And so I would just want to make sure that as we start to pursue this area, that truly we are meeting the objective. Because certainly I think we've heard, and it's hard not to think about what we hear in this project and what we hear in financial performance reporting about providing more disaggregated information. And, as we've talked about before, I think there's, a lot of overlap between these two. And so I want to make sure that we're trying to be true to the objective and not trying to answer another project's issue with this project. In other words, this is about the management approach. This is about how they use the information, not just simply providing information.
Christine?
So I just wanted to elaborate a little bit on the item that's in the memo that's described as, I think, additional standard setting opportunity or something like that, which is it's an issue that I've been concerned about based on some of the research that I've been doing on what companies are reporting with respect to segments. So the issue is that there's a declining proportion for which total assets is being provided. And that can be traced back to 2009 and the introduction of the codification. So prior to the codification being introduced, the percentage was 91, 92% every single year from the time that the FAS 131 came about through to the codification. Then the codification comes in, and we start to see a decline in the percentage of segments for which total assets is being provided. It goes from 91 to 90, blah, 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 to where we're today at 85%. That can be linked to a sentence that was pulled from a staff Q&A that was addressing a question of, if I don't allocate my assets internally, do I need to go through an allocation simply for external reporting purposes? And the staff's answer was no. You don't have to. But if you don't do that allocation internally, and that's why you're not providing total assets externally, then you should state that fact. But what got picked up in the codification was just this sentence, if you don't provide asset information, state why. So to just try to get a sense of whether there are other reasons why companies aren't providing total asset information beyond this, just not allocating them internally, we went and looked at 31 companies. We just randomly selected 31 companies, and we went to look and see what they did. And fully 30% of them did not allocate assets to segments. So then we looked to see, well, what's the reason why? So there was 5, 6, 7, 8, 9 companies in total that didn't provide the total assets by segment. 3 just ignored the requirement to explain why, so that there was no explanation at all. So a third of them didn't explain why. 1 said it was because they didn't allocate internally, which was the original intent of the staff Q&A. And 5 said that it was because the CODM does not regularly review asset information. So I would like us to, I view this more as a codification improvement project, not really part of this project. I think we just need to tighten up the language here based on what was picked up from the staff Q&A.
So I agree with that. When Christine walked us through that in our SGM, I was surprised that you could read the codification that way. I thought the earlier paragraph said if you have to do assets unless the assets aren't allocated, and maybe it's the structure of the COD, because the paragraph Christine is referencing comes later. And so if you look at those independently, I can see that reading. I'm not saying it's the wrong reading of the COD. It's just not how I would have read it. And so I thought it was required to be reported unless you don't allocate. And so I think it's just, to me, it's just technical cleanup, but I thought it was a good point.
Gary?
You mentioned, we want to eliminate the cash flow metric from the discussion. What I would say is, here's the recommendation. Why don't we tell analysts that, look, you can't break up CFO into operating segments. There's no way to do that, right? However, could you have an EBIT number, an operating income number, and a D&A number, which gives you EBITDA, which is a rough estimate, a crude estimate of cash flow. And if you included capital spending by division or segment, you would then have some ability to give a rough estimate of free cash flow. So I think we should ask them, if we can't go down the path of, you can't allocate CFO by segment. So I think some analysts might not understand that. But then if we went down this path of EBIT plus D&A, I can get to EBITDA.
I guess in response to that, I think I need to build out a little bit more what you're asking for here, Gary. Is today you're currently required to disclose depreciation and amortization by reportable segment. And today you're currently required to disclose a measure of segment profit. Is your ask that we would require companies to do something more specific with regards to EBIT?
Yes, I think as part of the initial phase of this project, meeting with users, I think introducing that concept, to get feedback on it makes sense. We have a measure of profit, which is gross margin, operating income. Some do EBITDA, some do pre-tax. The D&A, although required, many companies do not disclose D&A by segment. So we require it, but they don't disclose it because the CODM doesn't theoretically analyze it. So my point is just to introduce the concept to analysts. If we would require this, would this be useful in light of the fact that we can't split up CFO by segment?
The impression I was getting, correct me if I'm wrong, was you don't want to take off how to improve cash flow information by reportable segment at this point. You'd like to engage in a discussion with investors. If we go to investors, I think he's asking for that to be as part of that exercise.
That's-
However best to communicate and get the input.
But what I think I'm hearing is you're saying based upon income statement elements, not based upon balance sheet elements.
Possibly.
That-
because
that's
it's a rough-
what you've
a rough
described.
estimate to get to the point, if we determine we can't do a cash flow number.
Right, because what we've heard is that the balance sheet elements aren't already there from which to derive an indirect cash flow measure. So you're trying to make sure that those aspects of P&L that are there are identified if they're included in the segment measure. I think that's what I heard you say.
So let me kind of see where we are. With respect to question 3, I think we've solved that. Yeah. Do we have any comments in the feedback summary? I think we've solved that. Okay. Yes, we probably don't need to vote on that. Helpful comments from the Vice Chairman. All right. Broadly speaking, I think we're in broad agreement with your plan. We have a discussion about adding emphasis related to cash flow. Pulling aside what Christine talked about, total assets, because I have a different idea for that. I'm thinking maybe we ought to carve off that piece of information, because that sounds like something that we could hopefully address sooner than this, and an idea how to do that. Any other things about adding or subtracting based on the staff's plan as we've talked about, other than the total assets? Yeah.
The only other thing that I probably wouldn't have included in the plan is research and development. And it's only simply from the perspective of having had experience with doing a ton of research on research and development in another separate project where there's a lot of inconsistency across the profession on what is research and development. And so for purpose, I wouldn't want to get into that as part of this project. And so I probably would have hived that off, but I'm not opposed to looking at it.
But so are you saying you would prefer not to discuss research and development, or you would prefer to have a discussion that says, should you disclose research and development the way management has determined their policy for research and development? Because your basis is there's
Right.
multiple ways in which people categorize costs.
Well,
everywhere,
I would be
including
okay with
research.
it if it's the way management
So-
does. It's going to be inconsistent. I
It's
mean,
going to
we
be
have that
it's going to
in
be
other areas of
inconsistent,
GAAP
but it is
too.
the management approach. So,
Right. I'd be okay with that.
Marcia.
But if we look at what's listed in in the handout as item D, a principle-based disclosure requirement that talks about significant expense categories, some of the feedback we have from the study is across multiple industries, R&D has different degrees of specificity to the segment or to the consolidated number. I think if we further develop, which I think I'm hearing from the comments, a lot of support for making this D the core, the principle base, I'm thinking that might address what Sue is saying, that instead of treating R&D as a separate requirement in isolation, I think that it may be more meaningful for that to be covered under this principle base so that companies can then, if it's relevant to their industry, and if it comes out that way. So I think I agree with you, because I think I'm not supportive at this time of going specific down a specific traditional income statement caption and forcing it into a segment model if it doesn't exist there today. I think that's going, as Sue said, outside the scope of what we're trying to do. We're trying to take what's already been defined by management as their segment measure and provide a little bit more information about how they see their business. And if that's a relevant matter, I think it would come out through the principle-based disclosures.
Okay.
You know,
I'm trying to. So I think what you're saying is we wouldn't explicitly require research and development. We'd be looking at what are the types of substantial or significant expenses that management has allocated and managed. It wouldn't be explicitly saying research and development is one of the ones. It's just if it's significant to the segment or to the CODM, you'd put it in however they're managed. I think that's the distinction,
Yeah.
right?
And I think,
I-
isn't the staff saying that, look, at this point, they haven't decided what their recommendation is, whether we should go down a list or do principles, and they want to get more work to determine their recommendation?
So
Yeah.
it seems like we ought to let that
I have a
proceed.
particular sensitivity about, because the segment note isn't necessarily always on a gap basis, I could see where there could be some confusion created
Yeah.
by having that item. If it's not, then you have this annual research and development expense that has a required disclosure. That's inconsistent. But I'm happy to explore it, and I think if you go down the path of significant principle, that might be okay.
Okay. But your thought is to go down significant principle, a principle-based approach for assets and cash flows and expense, assets, and liability categories. To me, I wouldn't take research and development off, but I'd be sensitive to this dialogue as you talk to people, just to see what's the best way, because Sue and Marcia are right. If we do require explicit R&D, it may be inconsistent with the management approach. So we're okay with that kind of strategy? Okay, let's go back to Christine's point about total assets and what Jim Croker talked about is, I'd like the staff to think through some proactive ways to get the message out about how to navigate the COD in this area. That may be a technical improvement. That may be a staff Q&A. Don't want to prejudge how that is, but what I sense is that there may be various views out there about whether this is required or not, and if we think it should be required, what's the most efficient way to get that word out and come back to us, but not as part of this project, because I think if we think it's required, we think it's useful, I'd rather get that message out sooner rather than later. Is that okay with everybody? All right. Anything else on segments? You want to move to FPR? So no team shift? Not really?
Chair shifts.
Oh, literally, your
Chair shifts.
we could have given Chris a microphone. But. Is this, we're always nice to people in the first meeting. Is this still considered his first meeting? I mean, he was in the. Go ahead, Chris.
All right, we'll switch gears now to financial performance reporting, or FPR, and the disaggregation of performance information. The purpose of this meeting is to discuss the feedback received in response to outreach conducted by the staff on the internal view approach, which was approved by the board at the April 24th, 2019 board meeting. The staff will also discuss interactions with the segment reporting project, as well as staff recommendations for next steps. As a reminder, this is the second round of outreach that has been undertaken for this project. The first round focused on understanding the implications of requiring disaggregation of income statement line items by nature and function. And the staff presented its findings from that outreach at the December 19th, 2018 board meeting. Given the identified challenges of the nature and function approach, the board decided to consider an internal view approach in this subsequent outreach. The goal of the internal view approach is to provide disaggregated income statement expense information based on the way it is viewed internally, which may or may not be a disaggregation by nature. Ultimately, this approach aims to help users understand an entity's performance and assess prospects for future cash flows using information that is aligned with management's perspective. Chris will start us off with a summary of the internal view outreach feedback.
Thanks, Danielle. The staff conducted outreach with 8 preparers and 4 advisory groups to obtain feedback on the internal view approach to disaggregating consolidated expense information. The outreach was conducted on 3 main issues, and those were identifying the internal view, disaggregating cost of revenue and SG&A specifically, and disaggregating total income statement expenses as an alternative. In terms of identifying the internal view, the staff noted that each participant who were preparers was able to identify an internal view, and many participants indicated that they prepare multiple internal views with varying information sets based on the intended audience. The The most common purposes for reviewing disaggregated consolidated expense information include budgeting and forecasting, variance analysis, internal performance assessments, and preparing MD&A and other earnings press release materials. The finance function is the most common user of the disaggregated internal views. The internal views also tend to be consistent from period to period with supplemental ad hoc reporting for significant non-recurring transactions as needed. We received the following feedback from preparers on the alternatives for disaggregation using an internal view. Only a few participants disaggregate cost of revenue in any meaningful way. Others utilize very limited disaggregation or no disaggregation at all. Conversely, nearly all participants indicated that they disaggregate SG&A. However, the degree of disaggregation varied significantly by participant. When considering disaggregation of total income statement expenses, most participants stated that their internal view differed in some way from the face of the income statement, but the level of disaggregation varied based on the purpose for which management used the information. And finally, system constraints and the effective allocations, which would lead to costly reconciliation efforts, were cited by multiple participants as operational challenges they would face if disaggregation using an internal view were required in the financial statements. Participants also provided general feedback on the internal view approach. Several participants noted that the internal views of disaggregated expenses form the basis for their MD&A disclosures, and there was some concern over the costs associated with potentially moving information from MD&A to the notes. Nearly all participants noted that their internal views were prepared on a non-GAAP basis because either the use of adjusted metrics like EBITDA, differences in classification, or the effect of allocations on line items. Several participants observed that a restatement obligation resulting from changes to the internal view would be time-consuming and costly, because internal reporting is likely to be subject to more change than other reporting. And participants were not supportive of presenting disaggregated expenses based on the internal view on the face of the income statement, and some expressed concern over reconciliation efforts and internal control considerations if disaggregated information was presented in the notes. So based on the feedback from participants, the staff identified several themes. Information provided by management's internal view may not be reconciled to the consolidated financial statements in a cost-efficient manner because of the use of non-GAAP information and the effective allocations on line items. The use of the internal view may not result in a degree of disaggregation that is significantly different from what is already provided either in MD&A, the notes to the financial statements, or other earnings press release materials. And the internal view approach would not produce comparability between entities, and changes in the internal view over time may prevent meaningful trend analysis. And lastly, disclosure of sensitive or confidential information could result in competitive harm. Feedback from advisory groups was mixed in terms of the decision usefulness of an internal view approach and whether the benefits would justify the costs. Some users indicated that the lack of comparability between entities should not be a deterrent because of the value of trend analysis for specific entities. That said, preparer advisory group members shared many of the same concerns as those expressed by the outreach participants. The staff also performed research to understand the presentation and disclosure requirements for common non-recurring transactions with a goal of identifying the extent to which current guidance requires that an entity disclose the financial statement line that is affected by those transactions or events. The details of the additional research can be found in the handout starting at paragraph 117. Overall, the staff noted that, in many instances, entities are required to identify the income statement caption in which non-recurring items are reported in accordance with current guidance. And with that, I'll turn it over to the board to discuss. Question 1, does the board have any questions or comments about the internal view approach or the feedback received from stakeholders? And question 2, does the board have any questions or comments about the additional research performed by the staff to understand current disclosure requirements for common non-recurring transactions?
Marcia?
I may cover more than just question 1 and 2. But I do think that was a very nice summary. The sessions I was able to attend, I think I heard your summary in the context that I heard the comments from the participants. And again, I want to thank our participants for doing this. I think that the staff has done what we asked them to do, which was we've heard from users going back to the invitation to comment back in 2016. More information would be helpful. I think the scope of our project was, as it relates to this, let's take the income statement, acknowledging this is a GAAP statement with GAAP terminology, and let's see what is a cost-effective way to take a look at what's already there. I think the staff looked at two models that already exist in other aspects of GAAP and of the codification, one being the nature and function. And again, I think the feedback was consistent there, that there was not a clear, cost-effective way to move forward with that model. Then I think the staff responded to, let's look at another model. Let's look at the management intent, which in theory, or management view, which should be more cost-effective because it already exists. But I think what we discovered as we went through some of this is sometimes that management view on a consolidated basis is, again, not a GAAP number. It's a number that's driven or tied to the segment measures, which are not, by definition, GAAP measures. And I think pursuing this further, from my perspective, could result clearly in information that's not comparable company to company. It may be consistent, but we also, I think, would have a cost-effective question, because to stick to the scope of this project, which is U.S. GAAP as defined on the income statement, we're talking about requiring a lot of changes even to that information that is there. So at this time, I think the staff did a nice job of doing what we asked them to do. I can't think of anything else to do. And at this perspective, I'm comfortable no longer continuing down a research mode, and I would also be comfortable concluding that we have done everything that we thought we could do, and we haven't come up with a cost-effective answer to continue to pursue this project.
You weren't kidding when you said you're going to go beyond one. Anything? I thought what you did was excellent on the internal view approach. I appreciate the robustness of the research. Recognize that sometimes you go and you get input, and the input's useful, and even though as a result you may change direction. So, Christine?
So I'm going to have a slightly different perspective than some of my fellow board members just voiced. I did not to the extent, though. I thought you did an excellent job. That we all agree on. So when I go through the list of reasons for not continuing with this project, they come up also in the segment reporting project. So for example, we said, well, reconciliations are costly because the information is non-GAAP and because there's allocations. Well, reconciliations and segment reporting are also affected by the fact that the numbers are non-GAAP and that there are allocations across segments and within categories. So that, I feel we should continue with the segment reporting project. I would argue I don't view that as a reason to kill this project. Another concern is that there may be changes across time, and the information may not provide as much trend information as a result. Well, segments change over time, and so we have to address that in segment disclosures. I think we could similarly consider an approach to address it in these disclosures. There was a concern that was stated that the information is not significantly different from what is provided elsewhere, and yet we talked to, 8 companies, and 3 of them, so more than a third, said that it would result in disclosure of information that is not already disclosed on the face of the statements, in the notes, or in MD&A. So there would be additional information for a significant population of companies. And then the last piece was competitive harm, and the concern that providing this disaggregation is going to lead to competitive harm. Well, if that's true, then it's going to be even bigger problem when it comes to segments, because providing more disaggregation of expense line items for smaller components of the company is going to provide even more insight. And if they're concerned about competitive harm in terms of the consolidated information, they're going to be even more concerned about competitive harm at the segment level. So my concern is if these factors led us to the conclusion that we should kill the FBR project, I'm very concerned that they will ultimately down the path lead us to the conclusion that we should kill the segment project, in which case we end up with nothing. So echoing what Hal, the advice you gave me when we were talking about liabilities and equity, and that is I don't think we should kill things too early. You know, I would have preferred that we continue the two-track approach with the hope that at the end of the day we end up with something, as opposed to giving up on this piece now, putting all of our eggs in the segment basket, and then increasing the risk that if that project doesn't go through, then we're back to making no improvement in an area where I agree with Marcia. Users have said loudly and clearly that they want better performance reporting information. So that's my concern, and I would have preferred, I think there are things that we could continue to do in this project, so I would prefer we continue the two tracks.
Just for the record, I wasn't saying kill a project. I was literally trying to ask the question of 1 and 2. I'd like to focus on 1 and 2 and get things. I think we should continue. I just don't think investors want an internal view approach on the face.
Right. Could be in the
No way
notes.
was I referencing anything related to segments.
I didn't mean to upset you.
Well, you said you felt so you included me in there. But if we want to, I mean, if board members want to talk about all 6 questions at once, we can do that and just ask the team to tee it all up.
I think it's easier because they're all interrelated. It's kind of hard to.
Okay, so why don't?
I could tee up an internal view approach thought.
Okay.
We want to do that?
Well, that's what we're trying to do, but others are trying to go. So why don't you do the internal view, then we can tee up everything
If I think about the
else.
internal view approach from an investor perspective, it could be really useful. But then, knowing how accounting works, you know, once you get on the internal view approach, is this similar to some of the problems we have with the CODM approach? To me, it seems like the same problems. Companies will do what they want to do. You could have lack of comparability. That's a clear issue. When a CEO, Tom Smith, is fired and Mary Jones becomes CEO, what if she has a different opinion on what the internal view is, and you recast the income statement to basically the new look for the management? What does a company do who has 3 or 4 segments that have very different business models, and the way the management will look at each segment would have very different income statement line items? Or you have acquisitions. The same thing that happens with the segments. And you got to recast everything. Analysts hate having to change their models. So the more consistency, the more comparability, to me, lends itself to not going down the internal view path.
Okay, why don't you tee up the rest of the stuff and then what do board members want to do? Do you want? Okay, go ahead.
That's okay.
I mean, let's tee up everything, then we can have a free for all.
Thanks, Russ. As the board discussed in the previous topic, the segment reporting project is currently exploring additional disclosure requirements by reportable segment. Certain of those additional disclosure requirements would provide disaggregation of expenses by reportable segment or yield other disaggregated information by reportable segment. Although the focus of the FPR project is to provide disaggregation of consolidated expenses, the staff believes that the disaggregation of expenses by reportable segment would be more decision useful than disaggregation of expenses at a consolidated level. The staff identified the following potential disclosure requirements in the segment reporting project that would yield information by reportable segment which could also achieve or enhance the stated objectives of the FPR project. First, the segments project is exploring the addition of 4 items, including cost of revenue, to the existing list of segment disclosure requirements. If the board proceeds with adding cost of revenue to the list, users would receive a disaggregated view of cost of revenue by reportable segment, which the staff believes would provide decision-useful information. However, the staff acknowledges that such a requirement would not disaggregate cost of revenue into lower-level components, for example, natural components, which is one of the objectives of the internal view approach. Second, the segments project is exploring a requirement to disclose significant expense categories by reportable segment. If the board proceeds with this idea, the staff believes that such a requirement would exceed the usefulness of disaggregation of consolidated expenses provided by either of the internal view approaches. The staff understands that users place a high value on segment information, and to achieve disaggregation at that level rather than at the consolidated level would be extremely decision useful. Third, the segments project is considering ways to improve the transparency of the reconciling items needed to get from segment totals to consolidated totals, including a requirement to disclose a disaggregated view of the expenses included in the corporate or corporate and other reconciling items. If the board proceeds with this idea, the staff believes that such a requirement would provide a level of detail that would be considered decision useful. And finally, the segments project is exploring ways to improve the connectivity between financial statement line items and consolidated totals as disclosed in the segment footnote through a requirement to create a clear mapping from the segment footnote to the financial statement line items. If the board proceeds with this issue, the staff believes that the required mapping could yield additional information about the composition of financial statement line items that would help users ultimately understand the disaggregation of those line items. I was going to say, and with that, I would like to turn it over to question 3, but I think I'll just hand it to Sarah, who can tee up the last one.
Thanks, Sophia. So lastly, we'd like to discuss the staff's recommendations for next steps. Based on stakeholder feedback, the staff does not recommend moving forward with disaggregation using an internal view approach. The operational challenges identified by stakeholders related to reconciling non-GAAP views, combined with the fact that similar information can be found elsewhere, such as in MD&A, notes to financial statements, and earnings press release materials, do not support the conclusion that the benefits would justify the costs of requiring disaggregation based on the internal view approach. Additionally, the benefits to users may be limited by the lack of comparability across entities, despite the ability to perform trend analyses for specific entities. The staff notes that the additional research performed also supports the fact that the disaggregation of line items is enhanced by presentation and disclosure requirements of many non-recurring transactions or events. Because the staff does not believe the internal view approach is a feasible solution, the staff also recommends that the board make a decision regarding disaggregation by nature and function. The staff presented feedback from the nature and function field visits at the December 2018 board meeting and summarized that feedback in FPR Board Memo Number 7, which was reissued as a part of the meeting materials. On the basis of the feedback received during the 2018 field visits, the staff does not recommend that the board proceed with disaggregation by nature and function. Given the staff's recommendation to remove from further consideration disaggregation by nature and function and disaggregation using an internal view approach, the staff has identified 2 alternatives. Alternative A is to suspend project research to monitor the outcomes of both the segment reporting project and the IASB's primary financial statements project. Alternative B would be to remove the FPR project from the board's technical agenda. The staff recommends that the board select alternative A to suspend project research to monitor the outcomes of the segments project and the IASB's primary financial statements project. The staff believes that adding a requirement to disclose significant expense categories by reportable segment, which is being explored in the segments project, would successfully achieve the FPR project's objectives. The staff also acknowledges that any one or a combination of the other potential segment reporting disclosure requirements would provide users with additional disaggregated information and therefore would also achieve the FPR project's objectives. I can now turn over to the board to discuss the remaining questions.
So maybe the way to, if we were to add alternative C and D to question 6, and this I think may, the staff had teed it up to they were going to eliminate things and we're left with A and B, but in essence, I guess I could have alternative C could be continue with an internal view approach, and alternative B would be to continue with a nature by function approach. So why don't we do that? Marcia, I have you in alternative B, is that right?
Right.
And I would put you in alternative C, Christine, is that right? Okay, all right. So you see, I think Christine was signaling she wanted to continue with an internal view approach, and there really wasn't an alternative. Because now we're back on track. I'm going to go to Sue. Keep us on track, Sue. Come on.
So, from the beginning on this project, I think that back in the early days of the discussions that we've had with the Investor Advisory Committee, there's always been this acknowledgement by them that if we can get disaggregation through our financial performance reporting project, that would be good. But if we can get it through the segments project, that would be good. But we don't necessarily need it in both places. And so I think from my perspective, at least what I learned through the first phase of the field visits from last year, where we looked at nature and function. Certainly there were significant operability concerns and substantial differences on between companies, certainly that were more mature versus those that were had been around a lot of less years. On the internal view approach, I've always had some concerns that the internal view approach had too much overlap with what we were trying to do with segments. And some of the issues that we see today with CODM and the application of CODM and regularly reviewed and all that kind of thing would happen in spades with internal view approach. And what's management and what's, so I've had some concerns. I think then, couple that with a lot of the feedback that you've gotten through the outreach, certainly then you have concerns about, are we really providing good information for investors that provides comparability? And so from that perspective, I would be in the camp of the suspend the project, from the perspective that I think it's important that we make some improvements either through this project or through the segments project. And I think that what we just heard on segments earlier, I think we have a good plan and, sort of a robust approach to try and make some improvements there. And so I wouldn't remove this project from the agenda, but I would put it to the side for now, see what progress we can make on segments and see if, certain circumstances we can somewhat satisfy the objectives that have been posed to us.
So I've struggled with this project from day one, trying to understand, other than an objective of people want more, and we've been going at this for not just the time period I've been on the board, but I think the initial discussions are now 6 years ago just with respect to the current project, but decades before that of trying to figure out different alternatives to disaggregating performance and haven't really come up with what we've viewed as cost-effective solutions. So I've been skeptical about whether or not we were going to make significant progress in this without a more clearly articulated objective, and I don't think we've, in my view, found any approach that really accomplishes that. To me, the internal view approach, I thought when we went down that perhaps we could find something that was really about disaggregating gap performance, because that's, to me, what this was. We have an income statement that's not disaggregated, and that, to me, the outreach tells you, that really morphs into not disaggregating the gap income statement, but alternatively providing a different income statement and perhaps a different income statement than the segment income or segment performance measures. So we'd have one sort of segmented performance and then one additional footnote that is somehow functional and natural performance that doesn't necessarily tie to the income statement. I think that's where this has the potential to head, and I would rather not do that. If we're going to disaggregate further on a management view, I think we ought to do that within segments. I think that is effectively the result of the principled-based approach in segments without some other disaggregation that we wonder either how that ties to gap performance or how that even then reconciles to segment performance, and I'd rather do it as one. The nature of function approach, I think if we were going to do that, it requires a lot of standardization. We found that is not how entities look at it today, and while they track that for MD&A purposes, they all have different systems of capturing that, sort of the management discussion and analysis level, sometimes by looking at more sort of holding things constant. So I want to describe performance, so I need to know volume versus mix versus sort of a GAP compliant, 404 compliant. This is the disaggregation down to a number that you could feel comfortable putting into the income statement. And many haven't designed systems that way. To do so would be, I think we found, varying degrees of expense to extraordinarily expensive to somehow, newer companies may have systems that it would be easier. So I don't think we found a cost-effective solution there. So I'm probably closer to B. What I don't know is where I would do is I would take it off the active agenda. And so I don't know if that's A or B. A seems to say leave it on the active agenda. I would take it off the active agenda, put it in the research agenda, and monitor the IASB's work, because we already have a piece that I think is in the research agenda, which is the subtotals piece. And so I would just put this with the subtotals and then continue to monitor the ISB's project. And to the extent that we learn something useful from there, we could take it off of research and reactivate it. So I'm not sure if that's A or B.
I think
A prime. But he's an A prime.
I think we're going to vote. I think it's A prime, but that's I want to go back to something Sue said, and I really like the way she teed it up. She said, basically, give me more rows, if you will, in the income statement. That would be a good thing. Or you can give me more columns or more detail in the segments, and that would be a good thing. And I absolutely agree. Both of them are good things. And I think of it as a matrix, and you're giving me more cells of information. I can do more analysis with that. That's a good thing. I think where I would probably diverge a little bit from Sue is I think that if you had asked me that question 20 years ago, I would have probably said more rows. That was a good thing. All right. Most investors, I think, would have been more rows, good thing. I think today you've seen a significant shift to much more analysis being done by segment information. And I think that that's the starting point. It's not consolidated. The starting point tends to be segments today. And for that reason, I think more detail in the segment level is the bigger bang for the buck, if you will. So that led me to conclude that I would not, in the project, I think that if we did not succeed in getting those more cells of information through FPR, or excuse me, through segments, then I'd want to fall back to FPR and revisit the internal view approach. So at this point, I'm much more supportive of suspending. I would keep it on the active agenda, at least for another year or so. I would keep it on the active agenda. And do all the things that Jim suggested in terms of monitoring and watching what goes on, because I want to convey to our stakeholders that we're going to we're really looking for the best way to get more information, and I think that to take it off and put it back on a research agenda would maybe convey that we're just going to drop the project completely. So I think that the best way to approach this is alternative A. If I didn't if I wasn't successful in getting a majority view in A, I would go to C and continue to work on the internal view approach. I think there are many good aspects of it that will inform us about segments, and I would rather continue to do it that way. So at this point, I'm A, but would go back to C if that were not a majority view.
You want to address something you said? Because Gary was next in line.
I can go ahead.
Okay, go ahead, Gary.
Okay. From an investor perspective, I think Cal's right. People are looking more for segments. If you have a company with 3, 4, 5 segments, typically have different margins, different capital intensity, so therefore the analysis kind of starts with segment A, B, C, D, then unallocated, then I have my consolidated income statement, and that's how you model companies. But if I think about it, a simple solution for FPR would be to disaggregate SG&A. Now, the key metric you want is R&D, and what you find is most tech and healthcare companies who have a big R&D budget break out R&D on a quarterly basis, although it's only required annually. So if you broke out SG&A between sales and marketing, G&A, to me, sales and marketing and G&A are two separate, distinct aspects of what a company does. And I always found it somewhat difficult looking at a company. Well, what is their G&A? What are they spending on marketing? Having that broken out could be useful. And I think if we suspend this project, we might, as part of the segment project, throw that question in, if under FPR we were to break out SG&A between sales and marketing, 1, G&A 2, and then R&D 3, would that be useful? Because I don't think you can do that on a segment basis, but I think you can do it on the income statement. And again, once you get to the segment level, that's where the real benefit, I believe, comes from this project. So you can kind of improve the income statement somewhat by breaking out SG&A, and then I think the real work can be done on these segments.
Marcia?
No, that was helpful. So I think what I've heard is Christine specifically state that you would like to continue to pursue the management approach on the face of the income statement.
Well, we had never decided it was going to be on the face of the statement or in the notes, so that
okay.
was still open.
But at a consolidated level.
But at a consolidated level.
I think I just heard Gary specify certain captions that you might like to pursue, would these captions work? That's different from either management format or the nature and function that we've gone through. The question I was going to ask, and Jim may have been a little bit more elegant in his language of, is this on the technical agenda, is this not on the technical agenda? When I was saying I was supporting alternative B, I was supporting alternative B because I couldn't think, if I was meeting with a stakeholder, either a user or a preparer or an auditor, and they said, this is on your agenda, what are you doing? I couldn't define what would we continue to do and what would the next step be. So that's why I'm very comfortable that we've gone down the paths that seem to be the most logical at this time. Jim may have a better way of saying that we need to continue to monitor other ideas that come up in this area and keep that on the research agenda. But my question to those of you that were not suggesting we remove this from the technical agenda is, how would you answer that question? What are we going to do, and why is this still on the technical agenda? And that question to me is relevant.
The easy answer to that is there is a problem to solve. It's been identified. And we're going to put all of our efforts to one solution, which is through segments. And if that does not work out, then our fallback position would be FPR.
And I just want to challenge, you said a problem to solve.
Yes.
I don't know I've ever heard a problem. I think I've heard I'd like more information, but I haven't had anyone say I can't buy or sell the stock.
I view that as less information to me is a problem. And investors have clearly articulated that as a problem. If you go back to, I think it was the 2015 FASB survey, this was top of the list for investors needing more information. So we can identify as a concern, a problem, issue to address, however we want to phrase that, but it's top of mind for investors.
Yeah, I just wanted to say I completely agree with Hal and Gary in that the focus is more, and probably Sue too, the focus for investors is more on segment reporting. And so at the very least, I would hope that we would come back to the FPR internal view approach if segment reporting does not pan out. I think what I'm trying to voice is just I'm a little bit more risk averse. That rather than spending another couple of years working on segments, if we were to do that and get to the point where we couldn't make progress on segments, then having to go back and revive FPR at that point, you've got the having to get back up to speed with the project, changes in board members and staff and all the rest of it. And that's just very costly. So I would prefer that we diversify our risk, frankly, by continuing with both, do the investor outreach on both at the same time, and I would be fine with us going forward and exposing segments first. I just don't want us to stop working on this project, waiting for an outcome that I don't see as a slam dunk by any stretch of the imagination.
Jim?
And so I guess under that approach, even suspending it has those same problems because we wouldn't have a team actively working on it. Board members will change. And the reason I struggle with keeping it on sort of the active agenda is I don't think we've identified a viable approach in the internal view. So to me, that then means additional decisions about what is it we now want to take this project and do. And I don't have an answer to that. Sort of to Marcia's question is, what are we doing in the active project? And if the answer is we're researching viable alternatives, that sounds like it's on the research agenda sort of at best to me, because I don't know what we would be pursuing actively in the project.
So here's what I think the distinctions are. I think those that are into the retain it on the active agenda, but wait or monitor the progress in segments in the ISB are of the view that there is a problem to be solved, but we're not yet convinced that that problem can best be solved for on-face performance. And perhaps it can be solved by that. Perhaps it can be solved through improvements to the segment disclosure. But those board members are convinced there is a problem that needs to be solved. I think those that are saying let's remove it from the active agenda and put it on the research agenda have less of a conviction there is a problem to be solved and would like more research on identifying is there a problem. And then those that are in the C and D camp are convinced there is an active problem, and they see the light on how a solution, be the internal view, consolidated face or footnotes, or a nature by function. They see the light and how that will solve their identification problem. I think those are unfortunately the 4 camps, and we'll see if we can make 4 out of the 4 camps. Is that?
No, Ross, I think you summed it up well, but you also go back to the FASEX survey in 2015, and we saw exactly the same opposing views where it was a high priority for investors. I think it was the lowest priority. In fact, it was not a priority at all for preparers. We again have heard that same feedback, but I don't want to put words in Christine's mouth, but I know that she's already thinking, what is our core mission here is to provide decision useful information to investors and other users. Right? Which is going to provide that? I think keeping it on the research agenda, the active agenda, but deferring any effort put forth until we have a little bit more progress on segments. If that doesn't pan out, then go ahead and just shift our resources back to the FPR aspects of this.
Gary?
We had one recent meeting where multiple companies told us they're increasing their spending on technology dramatically to improve their information, to get better information by segment, you name it. And, a little while it's going to be 2020. So I think we have to kind of change our thinking a little bit. The thought that these old systems can't provide information as we move into 2020, to me, I'm skeptical on that point of view. I believe a lot of these companies are making huge, leaps and forward in terms of new information, better systems, and I think we need to keep that in the back of our mind rather than looking back 10, 20, 30 years ago. Mm-hmm. And I think, therefore, the message to companies should be, we believe there's an issue that needs to be addressed, improvements need to be made. It's going to have to come through either the income statement or segments.
Right.
So at some point, you need to work with us to get to that objective. Because investors have highlighted there are issues that we need to solve. Better disclosure, better segment reporting, you name it, and we can do it, but we have to overcome this hurdle all the time, is that we can't do it from the company perspective. And I think, again, moving into 2020, we're in a new world. It's, companies have much better systems, much better data. They're telling it to us meeting after meeting after meeting.
Mm-hmm. So go ahead, Jim.
So you characterized it maybe as a problem to be solved, and I've struggled all along calling this a problem or not a problem. What I've heard is there's a desire for more information. And in order to provide that more information, we need to find cost-effective solutions. So I don't define that, I define that as a request. We've looked, but because it's certainly capital is being allocated, and it's being allocated presumably very efficiently. And so there's a request to say, could capital be allocated even more efficiently if we were to impose additional cost? And I haven't found that viable solution in this context yet. I think we have something in segments that perhaps helps provide that greater disaggregated information. And to me, continuing to pursue in an efficient capital allocation system, not perfect, is there more that we want to impose without knowing what that viable solution is hard for me to keep as an active project.
That's fair.
I would challenge Jim's comment on one thing that, highly efficient allocation, I think is what you said. To test that theory out, if you were to eliminate all segment information and rely solely on the consolidated balance sheet and income statement, I would take the bet with you that you would be not
arguing to eliminate segments.
No, I understand that, but I'm testing on what you said. I would suggest to you, if you're relying on the balance sheet and income statement that is provided today, that was what you were using, you would have not anything close to a highly efficient allocation method.
Yeah, I don't know. It's not provided for private companies, and that market is growing, as we heard, exponentially.
And generally what you do to solve that problem is dig far more into the details of the companies where you have access, where you don't, as you well know, in a public company.
So let me ask the question in a slightly different way. So before I do that, Gary, is your leaning alternative D that I created, which was to continue but pursue nature by function, or was it more along the lines of wait until we have more research done on segments and the ISB's approach, which is kind of alternative A?
I think they're going to monitor segments and ISB.
Okay.
But I think we could ask the question during the segment outreach, if we split SG&A into these three categories, would that give you improvement to the information set that you get currently?
So where I am, I believe investors will benefit from greater information about the operations and activities of the entity. I'm not convinced yet if the most cost-effective solution is more disaggregation on the performance statement or more rows and more columns and segments. I actually have always felt they'll have greater benefit from more rows and more columns in the segment footnote. And so it's difficult for me to have a definitive conclusion on performance reporting until we're further along in segments. And so I would like to keep this on the active agenda, but direct the staff and the board's attention to researching segments, providing that research to the ISB as part of their agenda consultation, and hopefully convince them to put that back on their active agenda, and then monitor their progression on performance reporting before actually having a determination, which is in essence view A. Now, if I were to call a vote about who wants to remove it, I think it's only two that want to remove it. Is that fair?
Well, and I'm comfortable modifying this to keeping it on the research agenda.
Yeah, so B would be to remove it and keep it on the research agenda.
Right, because when we go meet with stakeholders and we go through our technical agenda requirements, this will be there forever. And we're either going to say we're doing nothing, or we're going to say we don't know what exactly we would do. We're prioritizing another project first. I think that's what I'm hearing.
That is what A would say. A would say is that we have sufficient, in individual board members' minds, sufficient information to conclude that investors would benefit by greater disaggregation of information. I recognize that's a broad term, right? Can't disagree with that, but well, you could, I suppose. But anyway, and we're trying to determine the most cost-effective way to balance that on-face presentation or notes, and then within the notes, is it consolidated or is it with segments? And we needed more research on segments until we come back and look at that. You could argue that the substance of that perspective is to combine the two. You could argue that. Not saying I want to call a vote to do that, but you can argue that. Whereas I think what B says is, no, right now, we don't believe there is, we're still testing whether or not there are cost-effective solutions. So the difference between A and B would say is, B says, we're not sure there is a cost-effective solution. Let's go research if there is. A says is, I'm sure there's a cost-effective solution. I just don't know that cost-effective solution is on the face or in the notes. And I need to wait until we have more research and segments to know. So that's kind of the substance.
I would just point out, though, that the cost is not affected by whether it's on the face or in the notes. The cost would be the same for a change. Which the argument that will be made in order to kill segments just like FBR. Hence my concern.
It does, it's a fair point. It does, however, in my mind, eliminate view D. Right? because it kind of says the internal view approach is the approach we want to go down. But go ahead, Al.
This discussion is why, at the beginning of our discussion on these topics, said, I think we need to do some level setting with investors so they have a more realistic expectation as to what is achievable and not achievable under the current systems. And we can talk about future and what will be available 10, 15, 20 years from now. But I think we need to really explain to investors what can be done today. And a lot of the things that we've talked about on both projects, the ability to slice and dice information is not maybe what some expect it to be.
So if I think I'm going to have to ask for second preferences, the way my vote tally works here. But with respect to the view A, which would be we would keep it on the active agenda, but we would focus the staff's attention and eventually the board's attention to the segment project. And then ask that, similar today, both projects be brought at the same time once we have more information on segments about where the degree of emphasis should be. That'd be alternative A. Alternative B would be we would remove this from the active agenda and put it on the research agenda. Alternative C is we'd continue down an internal view approach, either the face or the footnotes at the consolidated level, and then view D is to continue down an approach which would be disaggregated by nature by function. Jim?
So, I turned it off.
You turned it on and off. Nice little
So,
trick, yeah.
You know, to me, the difference between A and B isn't that huge. It's a degree of messaging.
Yeah.
Which B says we're going to have it in research. A says we're going to suspend it, presumably while we're doing research or monitoring other things. And so to me, I prefer the messaging of B. I certainly don't object to A. So I mean, if you're looking for second choice, that'd be my.
Okay, so let's just see where we are, and then we can make trades. Okay, alternative A. 3, 4, 5.
When you say A, and then you talk about monitoring segments in the ISB, and to me, is that A or is that D?
No, D would be.
Monitoring segments in the ISB would also be.
Did you say B or D?
A or D?
No, D would be as we would ask the team to move forward with views on how to improve the face of disaggregating nature by function. So we wouldn't wait for segments. We wouldn't wait. Yeah, we wouldn't wait. We would just proceed that way.
And I think I might be in A. Posed the question about, SG&A as part of the segments.
Which to me
Right.
is D.
As part of segments or face?
I think I am A and D.
A and D. Okay. All right.
Is that fair?
That's fair. At one point, you guys are going to laugh. At one point, I wrote in here combination. I'm like, nah, nobody want to do that. I should have gone with my gut instinct. Anyway, Christine?
I was just going to say, I think it's obvious my preference is C, but I'm actually going to vote for A because I don't think I'm going to carry the day on C, and so I might as well just go right off the bat for the fallback, which would be A.
So it seems like there is sufficient majority, 4 or 5, to go down your staff's recommendation, which is that we would be on the active agenda. We would articulate the next steps on the website, that it is, the next steps will be to monitor the progression of the ISB's performance reporting project, as well as progression of the FASB segment project. And once, with respect to segments, we will then bring this back for a coordinated conclusion with that of segments and the ISB's approach. And we can work on that language. That's okay? I think it's 5-2, right? So with respect to who's view A? That's 5-2, yeah. Okay. Anything else? All right. Before we depart today, today is Sophia Giannotti's last board meeting. Exciting last board meeting. I'm glad we made progress for her last board meeting. Sophia has been here for a year, worked on both performance reporting and segments, and has been a crucial part of the team. I understand she's going to be continuing her career working at Deloitte and their M&A group in Chicago. So we wish you the best in your next chapter of your career. Good job, Chris. First board meeting. All right. Thanks. We're adjourned for the day.